Most of us were given a blueprint for how to retire, but what if that blueprint is, well, fundamentally flawed? Today we're going to tear down the conventional wisdom around retirement savings using a really sharp, critical perspective from our source material. Let's get right into it.
All right, here's the game plan. We'll kick things off with the retirement plan we all know. Then we're going to hit a fundamental idea that changes everything: capital gains versus cash flow. After that, we'll dive into a pretty tough critique of 401ks, introduce an alternative called the Four Pillars philosophy, and then wrap up by sketching out what a totally new financial blueprint could look like. For decades, we've been sold this specific dream, right? Work hard for 40 years, save your money like you're told, and then you get to enjoy this amazing golden retirement. It's become the standard playbook for pretty much everyone.
This quote from our source just nails it, doesn't it? And the star of this whole plan is almost always a retirement account, your 401k. That's the plan at work where you put in a slice of your paycheck, maybe get a company match, and it all goes into mutual funds. It grows tax-deferred, and really, the core idea is the same whether you call it a 401k, an IRA, an RRSP. It's sold to us as the #1 ticket to our financial future.
Okay, to really get the core argument in our source material, we have to understand this one crucial difference in how your money can make you money. It all comes down to something the source calls capital gains versus cash flow. So capital gains, this is your classic buy low, sell high strategy. You buy a stock, a mutual fund, whatever, and you just hope, you pray its value goes up. The only way you actually get that profit in your hand is by selling the asset. By its very nature, this strategy is chained to the wild ups and downs of the market. Cash flow, on the other hand, is a whole different beast. This is the income an asset spits out for you month after month. The source gives a great example. You own a rental house. You get a rent check every single month. That income is consistent, even if the daily value of the house is bouncing all over the place. See the difference? You're getting paid from the asset, not by selling it. This right here is probably the best way to think about it. Capital gains are like having a golden egg. To get the gold, you have to sell the egg, and then it's gone. Poof. Cash flow is like owning the golden goose, the asset that just keeps laying those golden eggs for you. One is a finite resource you have to burn through, the other is a sustainable machine. And here is the absolute knockout punch from the source. A 401k is almost exclusively a capital gains vehicle. Its value is tied to the market's yo-yo movements. It is not designed to give you a steady paycheck, that cash flow we were talking about. And this one idea is the bedrock for the entire critique we're about to get into. So, now that we've got that huge distinction locked in, let's really dig into the specific problems our source has with making a 401k your #1 retirement plan. The source uses this really powerful analogy. Thinking about your 401k in retirement is like watching an hourglass. Every month, you have to sell off a little bit of your portfolio to pay your bills. You're literally watching the sand drain away. And the big, scary question is, will you run out of sand before you run out of time? And this leads to a pretty provocative question from our source. In a system where your returns are limited and full of risk, is there anyone out there who's getting an infinite return? And boom, here's the answer. The argument is that the financial companies, the brokers who sell you these funds, they're the ones getting a return that's basically infinite. Why? Because they put zero of their own money into your account, but they skim fees off the top, year after year, whether your account goes up or down. Then there's the massive issue of market risk. The source points right at the subprime mortgage crisis. The whole market tanked, and so did the 401ks that just followed it down. We're talking losses of half their value. Can you imagine being close to retirement, checking your balance, and seeing that half of it is just gone? But wait a minute, you're probably thinking, but aren't I diversified? Isn't that supposed to keep me safe? Well, the source argues that this is basically an illusion of safety. During that big crash, owning a tiny piece of 500 different companies didn't stop the bleeding. When the whole system goes down, that kind of diversification just doesn't protect you. Okay, so if the whole conventional model has these huge cracks in it, what's the alternative? The source doesn't just complain, it actually proposes a totally different way of thinking about investing, and it's called the Four Pillars philosophy. Let's break these down real quick. Fundamentals is about knowing the real health of an asset, like actually reading a company's financial statements, not just looking at its stock price. Technicals is about learning to read charts and market psychology to know when to buy or sell. We've already talked about cash flow, making your assets pay you. And finally, risk management. This isn't just diversification, it's actively protecting your money with real strategies. The idea is, if you master these 4 things, you can successfully invest in anything: stocks, real estate, you name it. And here it is, the real goal. Notice the goal is not to have $1 million in the bank. The goal is to build a portfolio of assets that creates enough passive income, enough cash flow to cover all your bills every month. When your passive income is bigger than your expenses, that's it. You're financially free. Now, switching to this philosophy, it requires a huge shift in how you think. It means you stop being a passive passenger with your set-it-and-forget-it 401k, and you start being the driver, taking a much more active, educated role in your own money.
The source even lays out this journey, calling it the education continuum. Most people start in phase 0, just totally hands-off with their 401k, kind of in the dark. The goal is to move through the phases, learning the basics, then practicing until you finally reach proficiency, where you are actively and skillfully making your assets generate income for you.
So what does this path really demand of you? It means you have to commit to learning. You have to take a hands-on role. You have to manage risk with your brain and your skills, not just by spreading your money around. And you need to build a team of true experts who are legally required to work in your best interest. So now we can put this all together. We can see how this new blueprint looks when you put it right next to the conventional plan we all started with.
Look at the difference. On one side, the conventional plan. You rely on the market going up and just cross your fingers that the hourglass doesn't run out. It's totally passive. On the other side, you've got the cash flow blueprint. You actively build assets that generate real, sustainable income. It's a hands-on, educated path where you build a system to support you.
And if you take away just one single thing from all this, let it be this. According to this perspective, real financial freedom isn't about how big your pile of money is. It's about whether you've built a machine, a golden goose that produces enough cash to pay for your life forever.
And so that leaves us all with a pretty big question to ask ourselves. Is the plan you have right now an hourglass, a finite pile of sand that you just hope is enough? Or are you actively trying to build a golden goose that will keep on providing for you no matter what?